Hello everyone and welcome to Sonen Capital's webinar. I'm pleased to welcome you to this webinar to discuss our 2015 Annual Impact Report. We were delighted to have over 300 people register for this today. I'm Meredith Benton, I'm Sonen's Head of Client Relations, and on today's webinar, Raul Palmares, founder of Sonen Capital, and Will Morgan, the head of our Impact team, will discuss our Annual Impact Report. We'll be accepting questions throughout, and we'll discuss them at the end of the formal presentation. To ask a question, look to the upper right hand of your screen. You'll see a little box. It's orange, and inside of it is a white arrow. If you click on that, a drop-down box will appear, and you can ask your questions within that. As I said, we'll accept them throughout, so please do ask them, and we'll answer them at the end of the formal presentation. I'm now pleased to introduce Raul Palmares, the founder of Sonen Capital.
Great. Thank you, Meredith. Good afternoon and evening for others that are joining us from abroad. I want to also add my thanks for your joining us today. We're really thrilled at the level of interest in our work that you've all come to hear today. So my plan is to really provide just a quick word on Sonen, then introduce our 2015 Impact Report, really focusing on what's new in this latest version of our annual report, and then hand it over to Will to cover in much more detail how we assess, evaluate, report on impact here at Sonen. For those not already familiar with us, Sonen is a dedicated impact investment management firm who believes that investment capital can help meet large-scale global challenges. We offer diversified, turnkey product solutions. We build customized portfolios and provide select consulting services to family offices, foundations, individuals on a direct basis or in collaboration with their other financial or professional intermediaries. In support of our work and the development of the ecosystem, at Sonen we really pride ourselves on being thought leaders and have a long-standing tradition of making available to the general public our research, impact frameworks, and the results. These reports and much, much more are all available for download from our website at sonencapital.com in the Thought Leadership section. Our 2015 Impact Report covers the strategies that Sonen designs and manages in fixed income, public equity, and private real assets. It's really important to note, though, that we leverage the same methodology that we've articulated in this report for specific client mandates and reporting across all types of social and environmental themes. Now, in our third annual release, we're really excited about the 2015 Impact Report's integration of the United Nations Sustainable Development Goals, or SDGs. And we're able to provide some of the preliminary impact results that have been generated from our private global sustainable real asset strategy. So why has an investment firm embraced, quote, development goals? Well, operating in a field which has yet to develop widely accepted and consistent terminology, the SDGs provide us a third-party, recognizable objective and really allow investors to coalesce around a common understanding to target and evaluate the results of their impact investments. Additionally, when you understand the investment requirements delineated to achieve the SDG objectives, these are on the order of several $1 trillion per year. That's trillion with a T. And we see this as an enormous opportunity to scale capital for competitive financial returns and meaningful positive social and environmental impact. So with that, once again, thank you so much for joining us today, and now I'm going to hand this over to Will.
Thank you, Raul, and thank you everyone for attending. We're pleased to have you today and to help acquaint you better with our impact report. I'm going to spend 10 or 12 minutes briefly introducing the purpose of the Sustainable Development Goals and give you some context and why we think they're important. I would like to illustrate how we evaluate the alignment with the goals through various different methods here that we use at Sonen, and then we want to showcase some of our early data from our real asset strategy. So first, starting with the Sustainable Development Goals. Now, here's what's exciting about these. These goals call specifically for the involvement of the private sector to get involved and to participate in the global sustainable development agenda. There's an explicit request to help businesses minimize their negative impacts and to have private capital participate more directly in increasing its private contribution and support goods and services and responsible business practices. So we think this is where we're seeing impact investing really have a call to action to participate in helping the world get to sustainable development by the year 2030. There are a total of 17 sustainable development goals, and we have mapped our investment strategies with 8 of them that you see on the screen now, where we think our contribution is most evident and most prominent among our investment strategies. It's important to note that not all of the sustainable development goals really create direct investment opportunities. Some of them, for example, call on nations and sovereign governments to participate with one another across international boundaries and to create policies which are more conducive to achieving sustainable development, and thus there's just not a lot of investment opportunity therein. Where we see our alignment with the Sustainable Development Goals across our fixed income and public equity and real assets is most prominent in Sustainable Development Goal 6, Clean Water and Sanitation, number 7, Affordable and Clean Energy, and number 9, Industry, Innovation, and Infrastructure. Our strategies individually contribute to a number of other Sustainable Development Goals, and we'll be highlighting those periodically throughout this report where it's most evident. With respect to our public equities and our work in that asset class, we use non-financial data to help evaluate impact performance. This is commonly referred to as the environmental, social, and governance, or ESG data. This data gives investors an excellent opportunity to evaluate how their assets perform along non-financial dimensions. This environmental data on this slide is communicating performance on average carbon intensity and water withdrawal intensity. The variable intensity simply relays how much carbon is thrown into the atmosphere as a result of producing 1 unit of output. So it's a great way to compare 2 companies in the same industry or a series of companies with their peers to see relative performance about how much negative environmental impact they may be causing as a result of their processes. We think that environmental data such as this speaks directly to Sustainable Development Goal number 12, which is calling on companies to reduce the negative impact of their businesses and to ensure sustainable production processes. Here and in our impact report, throughout the impact report, we report our non-financial performance of our global equity strategy with the MSCI ACWI Index to compare how our performance fares against a traditional market benchmark. Excuse me. Beyond environmental performance, we can look at social performance too. This slide here is displaying labor management performance and health and safety among the underlying securities in the strategy. This includes data on things like workforce satisfaction, the provision of benefits to employees, the rates of injury or accidents among the workforce on an annual basis. And we see here, this data speaks directly to Sustainable Development Goal number 8, which is helping create safe and productive work environments for corporations around the world. Last, we also look and examine at various attributes of how companies are actually governed. What is their corporate governance body actually doing? In this case, we report board diversity as measured through gender representation on corporate boards. We've taken some time in the last couple annual impact reports to explain the business case for having greater diversity on corporate boards, namely gender diversity, and we believe that's an important attribute and something that we pursue among our underlying securities. So all of this ESG data and more is available with further explanation in our annual impact report with some specific examples of securities that exemplify some of these attributes. Next, if we want to move to how to illustrate how different asset classes might contribute to a sustainable development goal, we'll take a look at Sustainable Development Goal number 9, Industry, Innovation, and Infrastructure. Each of these goals has a number of different underlying targets, anywhere from 6 to 10 underlying targets, and in this case, this goal is really calling for an effort to build resilient and sustainable infrastructure that increases resource efficiency around the planet. And another goal, which is important, is expanding access to that infrastructure in developing nations, and in particular, Africa. So in this slide, we show how specific investments across 3 different asset classes align with these objectives. The first is in public equity, and in our impact report, we highlight the company ACEA in Italy. This company provides, it's a utility that provides drinking water and drinking water infrastructure and waste to energy production technology on the outskirts of Rome, and it serves millions of people with that service. The second example is a fixed income investment. This is a U.S. municipal bond based in Boston, and this is a $231 million issue, which is updating and rehabilitating water and wastewater infrastructure in that city, serving more than 5 million people. It's reducing pollution by 90% and separating stormwater flows from sewage and wastewater, so there's not any cross-contamination there. Last is real assets investment. This example here is a utility-scale solar power generation in the U.S. We've got another similar investment in Africa and Uganda, and one that is not yet operational in Ethiopia, that are both providing large-scale energy production through renewable sources, one through solar and another through hydropower and geothermal. So these are just simple and quick samples of typical investments that we see across our investment strategies and across asset classes. We see these clusters of activity across our portfolios, and we are able to map a number of different securities to these SDGs. So in these examples, we can draw very clear and explicit connections between specific securities and their impact. But there's a lot of instances where that connection is not as easily evident, and that's a persistent challenge in this industry, is communicating where that impact exists and what it looks like, and how investors can have some confidence that the investments they make across asset classes are actually generating a positive impact that can be measured and quantified. We're constantly striving to build this industry's capability to express how this impact is created and how it's delivered to investors. Part of that effort is to move and create new variables that would help explain how impact is created. Some asset classes generate very specific impacts. Private equity, for example, you know that if you invest in a renewable energy facility in Uganda, you know exactly how many megawatts it's capable of producing and how many people it might serve. But for other asset classes, impact is much less tangible, and it's also less directly connected to investors' assets. So we want to better define how impact is created and delivered, and we want to move beyond some of the very simple notions that we are using now and the industry relies upon now. We've developed an evaluation tool for internal purposes that helps investors understand what they're getting beyond these financial returns. We call this tool AIMS. It's an acronym for Additionality, Intentionality, Measurability, and Scale. So additionality is the prevailing practice by which investors and grant makers, philanthropists evaluate their impact at this time. And that is a useful dimension which describes the incremental positive impact that results from making an investment, and very critically, that impact would have to be beyond what would have happened otherwise. So this is simply explaining, if I make what kind of return on investment do I have for $1? How many people are served? What kind of units of output are there? And additionality works very well for certain asset classes and certain investments. It doesn't work as well in other asset classes and investments, and we don't want to reduce our impact evaluation to one dimension of impact creation simply because we think that shortchanges the potential and the actual impact for a number of other investments. So as we expand these dimensions of impact analysis, we think also of intentionality. This is investor intentionality and investee intentionality. What does the investee want to accomplish? Intentionality is defined as making an investment with the intention of achieving a specific social or environmental return. Next is measurability, the extent to which impact outputs can be observed or measured or quantified. And last, scale. That's the size and the amount of impact that's achieved by a particular investment. As we apply AIMS to different investments, we can see how those variables really change and are expressed in different ways. These three investments in the public equity, municipal bond, and private equity are the same investments that I highlighted for the Sustainable Development Goal number 9, which was calling for sustainable infrastructure. So looking at public equity, we can see how impact is really expressed through scale. This utility, recall, was serving many millions of people in greater Rome and in the region with water and electricity and providing renewable sources of energy. As a publicly traded equity, though, additionality is very low. If I buy and sell that equity, it's not really going to make a big difference for how that company is producing its outputs and those good outputs. So scale is where public equity really comes to life with respect to impact evaluation. In contrast, if we look at the private equity, this was the utility scale solar power generation in the US and in Africa. This gives investors a much greater sense of what they're accomplishing with respect to additionality. In many cases, these investments would not be as large as they are without that addition of investors' resources. It's a great expression of an intentionality, and the measurability, as we'll see in a few slides, is considerably high. Where it's not so high is scale, simply because of the inherent scope of its work. It's unable to provide that kind of service to many millions of people at this time because it's a smaller operation. So moving away from these theoretical constructs, and again, AIMS is a useful tool for us internally to help explain where impact is coming alive and where it's manifest most evidently. But we also have in our real asset strategy some very specific quantified data that we're very excited about, and it's just begun to come in after our first series of investments in late 2015, and I'll walk through those in the next 3 slides. Our most recent investment strategy is in sustainable real assets, and it really delivers highly measurable, highly targeted investments across 6 impact sectors that are articulated in the impact report. Our first 5 investments cover 3 of those sectors, which I'll go through momentarily. The first 2 investments we made are in clean power. One is in Africa, and the other one's in Uganda in Africa, and the other one's in North America. In both these cases, we are able to measure the total amount of renewable power that's generated in megawatt hours. We evaluate also the total reduction in greenhouse emissions as a result of that renewable power generation, and then we evaluate the number of people with access to clean power. I'll note here, you'll see the iris badge in the lower right corner. All of these indicators are compliant with the impact and reporting and investment standards under the auspices of the Global Impact Investing Network. All of the data that we collect for real assets are iris compliant, and that's a very intentional effort to try to embrace the standardization of impact reporting in this industry. The next investment that we made in very late 2015 was in sustainable timber, focused in North America. This investment is so recent, we don't have all the underlying impact data points that we'll ultimately collect. But currently, we are measuring and evaluating the data that is available, which includes the total land under sustainable management, over 136,000 acres. We also look at the amount of land that is going to be permanently conserved. This is 314 acres that will be conserved in perpetuity, often made available for the public to enjoy. We look at the amount of that landscape that's under a third-party verification and certification that it's actually being managed sustainably. And we look at job creation, and last at ecological restoration. This is where in this particular case, stream banks and riparian areas are actually being restored back to their natural and original state in an effort to restore the ecological viability of that particular corridor. So again, These are early days for this investment, and the data that's reported is reflecting this young stage of the investment cycle within the strategy. We expect these numbers to go up considerably. Last two investments in real assets were in green real estate, one in South Africa and the other in the United States. The African investments are focusing on green workforce housing centered around Johannesburg, really focusing on reducing the water use, the energy use, and the materials that are required to build those buildings for the rising middle class in that country. In the U.S., in contrast, these investments are focused on urban communities such as Oakland and Chicago, and are building and refurbishing LEED Gold certified properties with extremely high performance on things like water use, energy savings, and amenities for tenants, the proximity to transit and other neighborhood conveniences. Again, this data reflects only the first 5 investments of this strategy, the real asset strategy, and all are very early in their own cycle, and they're only starting to generate such measurable impact returns. We expect to see both the number of data points expand as well as seeing each of these numbers inflate further as we get further down into the investment period. And so with that, I'll pass this back to Meredith.
Thank you, Will, and thank you to Raul. We'll now be moving to questions. As a reminder, you're able to ask a question if you look to the upper right-hand side of the screen. There should be a small box. It's orange and has a white arrow in it. If you click on that, a drop-down box should appear that should allow you to type in your questions. We'll begin with a few of the questions that came in while Will was speaking. We had a number that were talking about the same topic, so I'll combine them. Will, for the Sustainable Development Goals, are they influencing or changing the way that Sonen thinks about impact or analyzing our investments? And can you speak to the rationale around applying these to our investment portfolio?
Sure. That's a great question. We've heard this 1 or 2 times before, and the short answer is no. These SDGs will not necessarily influence our investment decision making. Our investment process has, what they really do is serve as an affirmation that we're on the right track and that we're doing and making some worthy investments. Our investment process has been underway for more than 4 years. This is our 3rd annual impact report, and this is the first report in which we're able to use such a framework, a third-party, very credible framework, to validate our results. So we rely on our own internal impact frameworks, some of which are published on our website and Raul referred to earlier. We have articulated very specific social and environmental outcomes that we expect to see from real assets investing, water investing, energy investing, etc. And our investments are informed by those frameworks and the outcomes that we seek, that we've identified, and that we think are most important. It just so happens that as the SDGs were published in late 2015, we were able to take a look at them and map them back to our own strategies and see that kind of resonance and see the strength of our investment strategy. So we'll continue on that course. I think we'll certainly look at those SDGs and see how emerging reporting standards may come out and how we might align some subsequent reporting to that. But we have some high confidence that our future investment strategies will continue to make very important contributions to those goals.
Great. Thank you, Will. I see a number of additional questions coming in. Please continue to share them with us. I'll combine a few again, and I'll ask about how we benchmark our strategies. Are we looking at a conventional strategy, or are we doing more an ESG or a sustainably oriented one?
This Raul Marathon, for all of you, I'll take that one. I think, the original thesis when we started this journey around impact investing was this notion and idea that, we aspire to deliver, competitive financial returns through traditional benchmarks with this meaningful impact. And so that was kind of the thesis. So as a result of that, we've spent, many years, and again, available through some of the publications we've done, really focusing on building solutions that would compete with and show the results relative to the traditional financial benchmarks. Why a global equity strategy is benchmarked to an MSCI ACWI or similar in fixed incomes. And so we felt that since we were holding ourselves financially to those benchmarks, those seem to be then the appropriate benchmarks we should hold ourselves accountable to in measuring and evaluating the various ESG factors that we're considering. now kind of in retrospect, having more time under our belt, and as a result of, the ongoing evolution of kind of the ESG frameworks and benchmarks and solutions that are available in the marketplace, we're absolutely reconsidering that because candidly, give ourselves a pretty nice handicap when we use the traditional benchmarks, given the types of companies I think all of us and those on the call probably understand are present in those portfolios. And so, our goal is to continue to iterate, and we've started doing some of that preliminary work in doing the same type of analysis and ensuring that we're not only are beating what the kind of incumbent and traditional paradigm of investing is, but really ensuring that we're working at the leading edge of the universe of ESG and sustainability investing.
Great, thank you. Can you speak to the data verification, whether we have third-party verifiers, and particularly what do we do in the emerging markets or other regions where the infrastructure may not be as well established around some of these sustainability data?
Yeah, that's a great question. Being how much of our data is third-party verified, and I'll bifurcate that response into both the public markets and then the private markets. First, for the public markets, for the ESG data, this is an ongoing industry challenge. Most of that data is not third-party verified. We gather this data from a third-party aggregator, much of which is collected from companies' own reporting. So we're all beholden to the data that is available to us. There are some exceptions. In many cases, because the investor appetite for carbon emissions data is so robust, there are greater and more strong mechanisms now to ensure that the carbon data that's coming in is, in fact, verified and cleaned and accurate and truly reflective of a company's performance. So we want, as an industry, to gain greater veracity with that data, and we're working in concert with other investors to encourage companies for greater disclosure and for industry standards on reporting so that we can all have a higher degree of confidence for that data that comes in, and so that we can evaluate it and be confident in what it's communicating. On the private side, we work to the greatest extent possible. We work very closely with our managers and we develop key performance indicators with them. We talk through all of that very specifically, and wherever possible we do try to collect third-party verification, such as in the sustainable timber industry, for example, the forest stewardship certification. And in green real estate, we're working, and we've reported specifically on the percent of properties that are under third-party certification, such as LEED or otherwise. So we want to rely on as much third-party verified data as possible.
Great, thank you. I had a question that's asked more about explaining the concept of additionality, specifically how you can have additionality in fixed income or in public equity.
Yes, as my initial remarks indicated, additionality is the prevailing standard by which impact is evaluated, and the reason we developed the idea of AIMS was because we thought additionality simply didn't capture the potential impact for publicly traded equities. If you think about a company that changes its policies to increase, think about Walmart trying to reduce all of its use, move to recycled packaging, trying to source its produce from within 50 miles of a store. Those are tremendous impacts, and particularly when you think about the scale of those operations. So that's why we want to widen those dimensions of analysis, so it's not just one variable but different variables, because we think there's tremendous potential in publicly traded equities and in fixed income to generate positive change. The other response I'd say there is that while additionality is intrinsically low in public equity, it can be significantly enhanced or amplified through the use of shareholder engagement and engaging directly with companies and agitating for them to do better and to change their policies and to make specific changes that we think are more consistent with our impact aspirations. And shareholder engagement is a big part of our program. We co-filed 6 resolutions last year. All of our work, and we're participating in a number of industry initiatives to try to increase transparency and disclosure, and all of that work is detailed in our annual report on our website as well.
Great, thank you, Will. Well, our intention today was to provide you with a brief webinar and an overview of our annual impact report, and we thank you so much for joining us. We know that there were a number of questions that remain outstanding and that we didn't have time to answer. We hope that you will contact us at info@sonencapital.com so that we can continue this conversation. For those who have not yet had a chance to view our annual impact report, that is also available online. Thank you so much for joining us today. This concludes our webinar.